Okay, folks, so welcome to webinar number 4, right? So we felt that cash was so important, we broke cash into two, not one, two webinars. The first one was the basics, the fundamentals, the blocking and tackling of how to put together a cash flow forecast that Mike showed you up on the whiteboard.
That's right.
And the second one is going to be, okay, now you've got your tool. What do you do with it? How do you turn it into something that's functional, that can provide value to you and guide you through this insanely difficult time of the coronavirus pandemic, right? I'm Lou Mosca, Chief Operating Officer of American Management Services, and for 34 years, American Management has been kicking ass and taking names, helping people get through one crisis after the next. The recession, now the coronavirus pandemic, craziness throughout the world. We save companies' lives every day. Hey, Mike, what's going on?
Hi, Lou. My name's Mike Lockey. I'm the Director of Management Services for American Management Services, and I work with all of our clients and all of our consultants to hopefully deliver very high performance and get the business owners where they want to go. So, Lou, I got a couple questions for you. Let me give you a hypothetical. Hypothetically, you have $10,000 in your bank today, and you watched our video last time, and you did your cash flow forecast, and you found by the end of June you had $9,500 in the bank. You satisfied with that result?
I guess it depends. You want to know what it depends on?
Tell me.
Okay, so I guess it depends. Number one, it depends on, did I get any quote-unquote free government bailout money, right? And did I go through that also? I guess it depends on what's my circumstance with my clients. Have my receivables ballooned? Did I use the money for payables quicker or slower than I should have? But ultimately, from a strictly management perspective, nothing going down is good,
right?
Other than my weight, okay? Nothing going down is good.
Yeah.
So if I had 10 grand to start with, I want to end with 10 grand or more.
Okay. So let me ask you a different question now, because I look at it as 9,500. That's not too far away from zero. You could easily blow through 9,500 in a short amount of time. So,
are you a negative guy all the time, Michael?
No, I try to be a positive guy.
Okay.
So let me give you the same question, but let's say you started with $1 million in the bank and you ended up with 950, i.e., you have a lot of room there before you get to zero. Are you satisfied with that result?
Well, reality is, to me, anytime you're eating into your liquidity, if it's a temporary short-term thing that you knew in advance was going to happen because it was part of your business plan or your cash flow model and you saw how it was going to be recovered, I might be able to be okay with it on a short-term perspective. I'm going to tell you right now, our 3 months of hell is more of 6 months of hell, and I can't believe anyone that's going backwards in liquidity is going to be able to recover in the next month or two if they don't have a solid plan in place. So $1 million to 950 is as bad as a 10,000 to 9,500.
Yeah. Have you ever met anybody that didn't want more cash or need more cash?
No, even Warren Buffett wants more. I mean, no,
right.
It's just absolutely, positively not. Cash is the lifeblood of every business and every entrepreneur. Good. And quite frankly, it's the ultimate scorecard.
Yeah. So I'm going to, let me make one comment, then I got another question for you. My comment
Why
is...
am I getting all the questions today, by the way?
I don't know. You're good at answering. That's why.
Okay.
So Lou, I look at the cash flow forecast as less forecast and more budgeting. Kind of like what you do with your profit and loss statement, whereas that's book profit.
Which is another conversation we should be having another time, because too many people do not budget properly.
Right.
But go ahead.
But we always believe that we want your book profit to translate into cash profit, and your cash forecast is also a tool that you can use to do that.
Sure.
So if you're increasing your cash position week to week to week to week and day to day to day to day,
yeah, your profit should be following that pretty strongly.
Absolutely right. So let me ask you the next question is conceptually, how do you go about improving cash flow? And I'm not talking about the details because we're going to go into some details here shortly, but just conceptually, what's the big picture and how this happens?
You mean the raise the bridge thing?
That's exactly what I mean. Come on, I'm trying to set this up, man.
All right. So in our world, we follow pretty simple philosophy. So the way to build cash is to raise the bridge, drive more revenue, hopefully at good margins, hopefully at incremental margins, or lower the water, which is keep your costs down, whether they're fixed costs or variable costs, keep your costs down. In today's day and age, it's a lot harder to raise the bridge, right? So while there may be a lot of stimulus money out there, and PPP money, and EIDL money, and ABC, and DEF, and whatever else is
what by that we mean coming in.
Coming in as revenue, as cash to people,
Right.
that's not, let's be honest, number one, it's not your money. And number two, it doesn't solve any revenue issue. It just doesn't. It's a temporary Band-Aid. It's a temporary Band-Aid. And you know what happens when you rip Band-Aids off, right? So nowadays, unfortunately, we've spent more time helping people with the lower the water piece, right? Trying to extend, balance out, measure, negotiate out what to do with whatever disbursements or outflows are going to happen. So, the way to, and we don't want to live on lines of credit, even though today's age, everything's open.
Yeah, I look at it like this, and we have lots of conversations, and we tell a lot of our clients this. If you were trying to raise the bridge and it's you're hitting it dead on, it's tough to do now because people are out of work, businesses are shuttered, people are clinging to cash. It's harder to raise the bridge. You're not going to get more volume in all likelihood. You're not going to necessarily be able to increase your pricing in that. But generally, even in normal times, when you try to raise the bridge, it usually takes a couple business cycles for that to happen, right? It doesn't just automatically
unless
come
you're
in.
a cash business.
Well, certainly. But for most businesses, it takes a little bit of time to see the real results of that. It might take a month, 2 months, 3 months. It could take, if you're in the construction industry, it might take you 6 months, a year,
Yeah, right.
longer.
And then even if it takes 6 months or a year and you have 10% holdback, that's all your profit.
Exactly. On the flip side, if I cut costs today, if I cut $1 cost today, that's $1 that goes into your pocket. It didn't leave your building. So you get more immediate results out of the cost cutting than you do with the raising the bridge part. So lowering the water always has more impact sooner rather than later than as opposed to raising the bridge.
I read yesterday that the NFIB, National Federation of Independent Business Owners, says that 50% of small businesses will be out of cash by May 31st. Okay, I don't believe it. I think they're out of cash now.
Right.
And since there's 30 million small businesses in the United States, that means there's a potential that 15 million will be belly up in the next 30 to 60 days.
Yep.
That's horrifying.
So let me ask one more question before we kind of dive into some recommendations here. We've mentioned in a lot of our podcasts and a lot of the stuff that we've been doing, we probably mentioned it a time or two through these webinars. If you didn't have a strong balance sheet going in, you're going to have a hard time navigating through that, and even including getting PPP or some of the government assistance. Just real quickly, and I know this is a conversation we could talk for hours on, but tell me, just give for the casual business owner that's there that isn't financially trained, what does that mean, having a strong balance sheet? Obviously, we're pinging on cash, so cash is part of that equation, but from a bigger picture, what should a business owner, or what could you give recommendation-wise to help a business owner strengthen their balance sheet? What should they be looking at?
To actually strengthen it now, or what a strong balance sheet looks like?
What does a strong balance sheet looks like?
Okay, so to me, first thing I look at on any balance sheet is current assets to current liabilities. It's the first thing I look at. And, there's industries that say if you have a ratio of 1.2 or 1.3 to 1, you're doing okay. I think that's absolute insanity. Insanity. Okay, but you want to have a solid cash position, solid receivables that are all within 30 to 60 days to the larger degree. If you carry inventory, you want your inventory to be relevant, saleable, current inventory, not stuff accumulating dust. Hey, I had a client 21 years ago that I talked to about 2 weeks ago. He just sold some inventory he bought 10 years ago. 10 years ago. He's already written it off 5 times. Bought it 10 years ago, was collecting so much dust, and he got back about 60% on $1 of what he paid for it 10 years ago, right? You got to be looking at yourself critically, but a strong balance sheet has a strong current position, current assets to current liabilities. Definition of a current liability is stuff you have to pay within 12 months.
Yep.
right? So current assets are cash, accounts receivable, inventory for the most part. For the most part. So how do you stack up? I'm going to tell you, you want to be in a great place, you want that to be 3 to 1. No BS on 1.5 to 1, 2 to 1. You want that to be 3 to 1. Why? Because it gives you wiggle room when shit goes wrong and stuff goes wrong.
Yep.
That's what a strong balance sheet looks like.
Yep.
How do you make one if you don't have one? That's the hard part.
Sure. I would just add to that, we said one of our foundational things is liquidity, right? Well, what does that mean, liquidity? And it's just kind of piggybacking off what you said. Your assets to me are liquid. Cash is liquid. It's the most liquid asset that you have. You can spend that today. Your receivables a little bit less liquid, right? If you can convert that into cash in 30 days, then it's got some level of liquidity. But it's not as liquid as cash because you actually have to go out and get the cash for it, right? You have to convert that into the cash. Inventory, another current asset.
But less liquid.
Right, but less liquid than even likely your receivables because you likely have to sell that inventory, which probably turns it into a receivable, which then you have to convert into cash. But
there's a reason why a bank's formula on a line of credit is normally 70-80% against qualified receivables,
right,
and about 50% against inventory,
right,
because they don't want it.
Right. Well, not only that, but they understand that you're not going to convert all that into cash.
Right.
There's risk associated with it. Cash, there's no risk. You can spend it. Receivables, if somebody stiffs you, the bank doesn't want to participate in that. Inventory, like you said, it could be sitting on your shelves collecting dust and have this much, and the boxes are turning yellow and all this, and the bank wants nothing to do with it. So you got to pay attention to, in my mind, of your current assets in your ratio, your working capital ratio compared to your current liabilities. But I also think within the group of assets, you could have a lot of current assets, but they could be fairly illiquid, or whatever that term is, because it's wrapped up in your inventory. How many times have we walked in on normal times to a manufacturer and they've got all this stuff sitting on their shelves?
That's the wrong stuff.
Right, millions of dollars of inventory, but they have nothing in cash. That doesn't do them any good. So let me just walk you through just a quick scenario, and this is kind of setting up the stage for how do we now approach things. So say you're the owner of XYZ Corp, and right now, because of Corona, you're doing about half of your normal revenue.
If they're lucky.
If you're lucky. But in this situation, let's just assume you're doing half. You do your cash flow. You got about 4 weeks to survive. You've made some minimal cuts, nothing major. You probably had to furlough some employees and that type of thing. But for the most part, you haven't addressed anything else operationally in terms of your operating expenses and how you're buying supplies and that type of thing. And you're still, as of now, on your cash flow, you're projecting to pay your vendors, rents, notes, all the stuff as normal. What should you be doing now?
I think that that's a loaded question, and I'll tell you why. Because let's say you were doing $6 million a year, and now you're doing $3 million bucks, right? So $6 million a year is $500,000 a month in revenue. $3 million bucks a year is $250,000 a month in revenue. But $250,000 a month in revenue may not be $250,000 a month in receipts. In fact, I'm going to bet it's not. Because people are hoarding cash. Right, everybody's hoarding cash. Big companies, multinationals are hoarding cash.
And they should expect that to back up even further.
Correct, and you could expect that to back up even further. That's why I think it's going to be many months before things feel a little bit better. So you have 4 weeks of cash to get by on at your current run rate. Well, you've already made a mistake. You should have made significantly more adjustments weeks ago. The minute things hit weeks ago, you should have had a plan, an action plan, and I'm sorry, you're better off to everybody get a degree of hurt than the company get crucified, right? Yep. So some steps you can take right away. Yep. Notify your vendors. Okay, what they normally would have gotten over the next 30, 60, 90 days, they're going to get over the next 6 to 9 months. You need to also negotiate with your vendors for them to give you a bigger line of credit, bigger credit availability, so you can still continue to work. You need to get with your landlord if you're a tenant, right? And the way to deal with landlords, folks, is pay them something. When you tell them you're giving them nothing, you're hurting them.
Yep.
So if you've been a good tenant, don't hurt them. Give them something. Your rent's $10,000 a month. Well, for the next 2 months, I can give you $2,500, then $5,500. So scale it up over time. They'll work with you more that way. And I have to tell you, don't ask them. You got to tell them.
Right.
Politely, respectfully, you have to tell them what they need to do. And then you got to address the elephant in the room that nobody wants to address, and that's headcount. You have to do it. So if you had 35 people at 6 million, and now you're at 3 million. Half of 35 people is 17 and a half. I'm going to suggest 17 and a half needs to be closer to 12, because you're not going to collect at the rate that you're invoicing, Michael.
Yep. A couple things that I had noted down, and you know me, I tend to start with the person, the people, the owner in this instance. Yeah, you've done your cash forecast up to this point. First thing that I think you gotta do, and this is an internal thing, is you can't panic. You can't just say, "Oh shit, I'm dead." You know, again,
swearing was for me, not for you, Michael. Okay, go ahead.
Okay. Oh crap, I'm dead. You know, because you know I think there's a state of mind that you have to be in. You have to look at that and you have to focus at the task at hand. You can't just say, "Oh gosh, I'm going to be dead in 3 weeks." Oh, fold it up. Again, how do we take 3 weeks, turn it into 6 weeks? How do we take 4 weeks, turn it into 8? How do we take the 6 or 8 weeks and turn it into 10, 12, 14 weeks? So I think that's first thing. Two, I think you got to understand that you do have some leverage in here. Think about your vendors. If you've had a good relationship with them up to this point, I think you have more than a fighting chance of working something out with them. But they're going to want their cash, right? Because they're doing the same. Ideally, they're doing the same thing that you're doing. They're trying
but you want
to
to stand out with them, be different,
right? Exactly. But the vendors need you just as much as you need them. They have to sell. They have product that they have to move through. They have people they're buying from, and it doesn't do any good for anybody to be the clog in this supply chain.
See, I just keep thinking with the vendors, all the vendors are hearing is we can't pay you.
Right.
I think what vendors need to hear is we can't pay you in full.
Right.
We can pay you a piece.
Right.
And this is how we hope to ramp it up. And we'll discuss it with you every week so there's no surprises. And by the way, that $15,000 credit line I have with you, you need to make it 30. That's the part people are not doing also, because you're going to need to keep your pipeline going somehow, which means you need a bigger line of credit with your vendors.
But to me, this is the tie into the cash flow forecast, because if you're just taking what I have in the bank today, I have $10,000. That's a solid number. That's what I have. If you just take that number, that doesn't give you any idea of what you're able to do week to week to week to week as you go out. And that to me is the importance of the cash flow, is that you have the ability to see what realistically can I offer to everybody. Because in a way, you can use that cash flow forecast as a sort of budgeting tool to say, I expect this much to come in, I have this much available, so I can spend this much if I want to maintain my balance where it's at. And like I said in the last webinar, you're not going to make, the goal isn't to make everybody happy. The goal is to put yourself in a situation where you survive. And I said a couple webinars ago, I never like a zero-sum game. And I think that's kind of where you're going with this. You can't just call up and say, I'm not paying you, blah, and expect somebody to say, okay, here you go. I think if you give them a well-founded outline plan, I mean, they may still say no, or they may want to adjust that to some degree, but at least you're talking about it, you're negotiating, and probably at the end of the day, you're going to get something better than what it would be as opposed to just paying everything in full or as you did in normal times. So
I think you get, what's that phrase? You get, attract more bees with honey.
Yeah.
Right? So if you want the bees to work with you, you got to give them something.
Right.
If you just want them to go away and think everything's going to be okay and you're going to be the guy standing in 120 days to be able to pay them, you're asking them to take a huge leap of faith. Do you want to take that huge leap of faith with your clients? Well, quite frankly, we've become a bank.
Right.
We've
Exactly
become a
right.
bank 10 times more than we normally would, but it is totally calculated.
So let me throw this out to you.
Oh,
One point that I had is you have to be a good communicator, and I don't think being a good communicator is just saying I'm going to ask for this, pick up the phone and dial. I think you got to practice that. I think you got to write a script. You got to note out what you're going to say. I think if you can role play it with somebody, have one of your key people be the vendor and give you counter punches so that you can be ready to kind of attack them whenever something doesn't go the way that you want it to.
I think this is a matter of ownership has to be the leader. And that's why you started this first series with leadership, right? And ownership can't go to Charlie the whatever and say, I need you to do this with our top 3 vendors. Ownership needs to get on the phone and handle it themselves. And ownership needs to be that communicative cog right in the middle of everything, and you're the master of ceremonies. That's what it is. But you also need to be honest.
Right.
Don't promise what you cannot do. All right, this is going to be a tough enough environment for everybody. Do not promise what you cannot do.
Lou, those are all great points. Let me give something that I believe in. How about just changing the way you process the checks?
You mean disbursements?
Disbursements, right. A lot of times we see with our clients, even in normal times, there's no rhyme or reason how they cut checks. Somebody calls them, they cut a check. Every day they pick a handful of checks, they cut that.
How many checks in a draw?
Could be a ton. Could be a lot. Could be a lot. So I said in other webinars, you're not on the normal playbook at this point. You're in survival mode. So how about instead of just cutting checks willy-nilly, you set up a process for that? How about one time per week? How about you cut checks Friday afternoons and you sign off on all those things? How about you actually see the list of checks that your bookkeeper or controller or whoever you have is going to run and approve that before they even sign that? So in other words, you have control over that process, and you strip that away from who you normally have to do that. Because a lot of times your controller or whoever gets a call from an angry vendor, pay me, and they cave. And here's a check. Next thing you know, a check's written and you're just signing willy-nilly. How about making sure you have control over that process so nothing's going out the door without you authorizing that, without you approving it, and then ultimately signing off on the check because you know exactly what's supposed to come.
And it's a perfect opportunity if you have 1% doubt over paying a specific invoice, don't pay it. Don't pay it. Everybody else is buying time. You need to be prudent.
Yeah.
You're not in the check writing business.
Yeah. Okay, let's shift gears a little bit and talk about operational expenses. And we've said before, you should be going line by line through your P&L. I actually think that should extend to your bank statements as well, so you actually see what checks you've repetitively have been paying out, so you have a feel for that as well. But let me play a little bit of devil's advocate here. I'm a business owner. I look at my cash flow; it's in bad shape, but gosh, I really need my labor. I got to pay my rent because I got to have a building, and sometimes I don't feel comfortable if I'm not making my insurance payments or my loans and mortgages. And then I got things like marketing costs and computer expenses and utilities. Again, playing devil's advocate, because I think the common business owner thinks about those things and says, well, I made an obligation. I gave somebody my word I was going to pay this, or I used that. I got to pay for it. What would you say to all those kind of things that you see from an OPEX expense?
I would tell you that every owner should be honorable, 1,000%. And that, when I came to work at American Management, I never even read the compensation plans and the non-compete agreements. I'd never cared because I believed if American Management did the right thing, I'd be okay. And now I'm here almost 22 years. I think a handshake and a conversation really matters. Okay, nowadays there's not going to be any more handshakes, but your word should be your bond. But everyone understands that the world is so much different. Just be honest. Be honest. Communicate honestly. So you made a commitment to your marketing folks, and you had a marketing budget of X. You want to live up to your commitment, but you can't do it all in one shot. Well, what can you do, and figure it out and explain it properly, and then make it work.
Good. Let's go back to headcount, your administrative staff. On one end of the spectrum, to a degree, you probably need some of those people, right? And some of the work that they do is important in the overall management of your business. On the other end of the spectrum is the fact that they're overhead. They don't help you generate revenue per se. And, it's a cost that, let's be honest, if you can cut, you'd want to cut. My belief is that you got to keep your payroll costs relative to the amount of revenue that you're generating and cash coming in.
Right.
You can't have $10,000 coming in this week and spend $12,000 on payroll. It's not going to work. So I do think you have to make the hard decision. Give me your philosophy on, and I know we've had this discussion before, but is it better to cut heads, or is it better to spread the wealth, meaning everybody feels a little bit of that burn?
Let's not spread the wealth. It's spread the pain. Right?
Right.
So I've seen it both ways. The thing I'm more concerned about is owners wait too long. they wait too long. And unfortunately, you can't get the money back. There's just no recovery period, right? So my philosophy is I'd rather traumatize fewer than more. So for me, and it's not a matter of the person, it's a matter of the dollars as a percentage of the collections, not dollars as a percentage of revenue. You can't pay bills with revenue, okay? So to me, I look at it as in terms of dollars. So if historically you've paid 50% of your collections in gross payroll, and now your revenue is down dramatically, you will not be profitable if you're paying 50% of your collections in payroll. It's got to be lower. It just has to be. So, I think the people that remain, and even the people that you might have to adjust, respect that you're making tough decisions. Just be honest. And I'm going to tell you, if you think you're going to have to do it in 3 weeks, you're making a mistake. Do it today.
Right. I think, and this is, again, how I think it ties back into the cash flow forecast, because you have visibility week to week to week to week. And as you said, last episode, potentially day to day to day.
Listen, I want to say one more thing on it.
Sure.
In 34 years, we have never allowed ourselves to be hired to give an owner what they want in terms of trimming employees or payroll or headcount. We have never done that, and we've never taken an engagement like that, and I hope to God we never do. However, payroll is such a huge percentage of everyone's outlay. To ignore it is almost certainly the kiss of death. Yeah, certainly. So you can't ignore it. You just can't.
Well, it's funny, even in normal times, and we, what would you say, half to 2/3 of our clients are in some level of pretty significant financial distress, right? I've physically have gone into clients, and we'll pull their profit and loss statement, and we'll go line by line, and we'll hit things like subscriptions and publications. That's $1,000, and they'll say, okay, we can get rid of that, and we can do this. And but they'll just bounce right over payroll. It's like it's so taboo to touch that. And you're absolutely right. I mean, a lot of times it's half, 70%, 80% of the total operating costs. And my belief on that is I'd rather share the pain a little bit across the board than to necessarily cut 2, 3. Now if we got to cut 2 or 3 because of the productivity level, then so be it. But I feel like it's a responsibility. I guess we live in a different world as well, because we live in a world of pay for performance, right? So if performance is down, then the compensation follows suit, right? A lot of our clients aren't in that situation. They're, it's base pay. They're getting their hours. They're gonna make their money regardless of what the top or bottom. That's why I kind of believe that they have a responsibility in that. Hey, we've been paying you to produce, and you haven't been producing. But and I'm not here to argue the semantics one way or the other. I think the point here is that
I dealt with a law firm about 3 weeks ago, and it's not a huge firm. They got about 60 people. And it's probably about 20 attorneys there, right? And they're laying off attorneys, right? Because attorneys are performance-based. They have to have work to generate whatever they're getting paid for. And everything is slowed down so much. So, professional services firms, they're 90%, 80% payroll, right? You got to look at it from a realistic perspective and forget that it touches a human being personally, because it does. It just does. But if you follow our 3 tenets to begin with, it's about people, it's about the integrity of your company, and it's about your liquidity. It can't just be 2 of the 3 or 1 of the 3. It's got to be 3 of the 3. So if you're doing a cash flow and you're looking at where you're at with your vendors and where you're at with your customers and what you legitimately believe your collections are going to be, and you start to see the distortions and what you're going to have to pay out versus what you're taking in, I'm sorry, there's nothing sacred, including you, Mr. Owner.
Right. I totally agree. And I think, again, this is all about tying this into, you have a cash flow now, what do you do with it? And I think that's exactly how you have to do it. You can't have too many periods of time, weeks or days, where your cash outflow is exceeding your cash inflow. Certainly not over the long term. And as you say, the reality is if your payroll is 80% of your cash burn, and you're upside down on that, you got to take that cash flow and you got to be realistic with that picture. Again, we're trying to say, how do I take 3 weeks of survival and turn it into 6? How do I take 4 weeks, turn it into 8? How do I take 8 and turn it into 12? You're not going to get there by ignoring the fact that what is likely your biggest cash outflow is going to remain unimpacted by that.
Okay.
So, anything else you want to add before we kind of wrap this up?
I think that this creates an opportunity. This pandemic creates an opportunity for owners to reset. Mm-hmm. If you got PPP or EIDL or some other CARES program and it gave you some temporary breathing room, you need to take it for what it is. It's temporary breathing room. Most owners that we deal with don't like paying their taxes. Most owners that we deal with don't like dealing with any governmental anything. Most owners we deal with don't like their bankers, right? They believe their bankers are good to them when they're doing well, but when things are tough, bankers turn the other way, which is historically the truth. Right. And now here there's so many owners clamoring for the banks and the federal government to bail them out. Well, even if they're fortunate enough to get bailed out, it's temporary. So this pandemic is going to give you the opportunity to reset. But if you don't control and manage your liquidity and manage your cash flow and manage your people and how you communicate and endorse total transparency, and you be the leader, you be that cop on the corner directing traffic, if you're not willing to be that person, you don't have to worry about what's going to be 3 months from now. You're not going to be there.
Right. I totally agree. Totally agree. I think in my part in wrapping this up is, again, this was a two-parter. Do your cash forecast, then take that and actually have plans in relation to that. And I think at this point, I kind of have to say, make sure you're playing the what-if game and you're being realistic. What if your revenues, maybe you're doing half the business now, but how do you know you're not going to go down to 25% of your business at some point? So you got to kind of play the what-if game, and that's what that tool's supposed to do. How do I slot things around, move things around? What do I have to reduce to be able to survive through this? Now, I fundamentally believe that you should be aggressive in trying to raise the bridge, doing whatever you can. I think the reality is that that's going to be very difficult. So, you gotta make sure that you're paying attention to how do I extend those payments out? How do I cut costs where I can cut costs? Make sure you're only focusing on the vital things that you absolutely 100% need to run your business. And again, that model is your tool to help you do that.
Just let me leave you with this. I think that any vendor, any creditor, any vendor, any employee you have to deal with, I think they need to know you have a plan. Mm-hmm. They need to know that you're confident in your plan. That means it can be a limp along, but they need to know this. They need to know how they're going to come out on the positive side with you at some point. You need to be direct. Don't sugarcoat anything. Don't accept your creditors and your vendors' first answers. Don't do that, all right? No is the best first opening line in any negotiation, right? So that's what you should expect to hear. So you have a choice, accept it or don't accept it, right? You own them, they own you. This is 50-50. It's 50-50, and this is a street fight you're in. So, these are tools to get you through this pandemic, folks, and, I hope you take advantage of them.
Cool. To those watching, thank you for subscribing to this episode. What are we going to do for our next webinar? I'm going to tell you.
Oh, shit.
So what are we going to do for our next webinar?
I don't know, Mike. What do you want to do?
We're going to do our first industry specific. We're going to talk a little bit about the restaurant industry.
Oh, my favorite topic in the universe.
So hopefully for those of you out there in the restaurant industry, you're getting some good nuggets up to this point, because everything we've said applies to you just like it does to everyone else. But we're going to spend a little bit of time specifically with that industry.
Very good. So we are here for you to get through this crisis, folks. Yell anytime.
There's no other industry that has suffered at the hands of the coronavirus as much as the restaurant industry. But that's not going to last forever. In this webinar, geared specifically to all you restaurant owners out there, we're going to give you practical recommendations on what you should be doing today to preserve your business and what you should be preparing for. So let us help you get back in the game.